On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Hi, team. Hope you're all well. I trust everyone enjoyed their holiday shortened week last week. For global share markets, it was a pretty good one for most markets. The S&P 500 in the US was up 1.3%. Emerging market equities added 2.3%, and the Aussie market, the ASX 200, gained 2.1%. European shares finished the week up 1.5%. They actually hit new highs in the wake of an interest rate cut from the European Central Bank, the ECB. We'll talk about that shortly. On the other side of the coin, we did see the Japanese Topix index slip a little bit. It was down 0.6%, and the local NZX 50 was down 0.1%, so only down very marginally. And that big earnings downgrade from Sky City did weigh on the local market. Interest rates were little changed. The US 2-year Treasury yield finished at just below 4.9%. The 10-year yield was down just marginally to 4.43%. And here in New Zealand, the 5-year swap rate fell 13 basis points to 4.49%. That did push fixed income prices up slightly. And the NZX Investment Grade Corporate Bond Index, which is an index that is a pretty good proxy for the fixed income investments that New Zealand investors hold, that index has returned 1.4% so far this year, and it's outpaced the local share market, which has increased about 0.7%. So bonds have actually been a better place to be in 2024 so far than New Zealand shares. At the moment, markets are pricing an official cash rate cut by November of this year. That's fully priced. So markets see that as a done deal by November, just for an update about where the thinking is at in terms of what the Reserve Bank will do next and when. Right, looking back on last week and some of the key releases, and locally it was a holiday shortened week with the Monday public holiday, and it was a pretty quiet one as well in terms of economic releases. We did get a fresh dairy auction, so we saw the results of the latest GDT auction, and headline prices were up another 1.7%. So that was the fifth consecutive gain, and the GDT index, the Global Dairy Trade Index, is at its strongest level that we've seen since October 2022, so it's up about 11.5% this year, highest levels that we've seen since late 2022, which bodes well for the 2024-2025 season. Fonterra did provide a business update last month, a couple of weeks ago, and it maintained that $7.80 midpoint for the payout for last season. And for the season that has just started, they've got an opening forecast range that has a midpoint of $8, which isn't bad. That would be the fourth highest in Fonterra's history. Doesn't mean farmers are making megabucks because costs are also up strongly. So $8 is not what it was 5 years ago. Input costs, wages, compliance costs, all of that sort of thing, much higher. So the break-even level for the typical farmer is certainly higher than it used to be. But with a bit of luck, that $8 midpoint does turn out to be conservative, and we see something that is closer to the mid-eights rather than sort of $8 flat. It was a much busier week in the US, and it started with the Institute of Supply Management Indices. You get a manufacturing index and a services index, and a bit of a mixed bag, to be honest. The manufacturing index for May was quite a bit weaker than expected. It came in at a 3-month low of 48.7, which is below that 50 break-even level, and it's only been above that level once in the last 18 months. So the manufacturing sector is in a difficult spot in the US at the moment. The new orders component was also much softer than expected. That tells you that there's probably more softness ahead. That fell to 45.4 in May, and that was the lowest in a year. More positively, we did see inflation indicators soften. And the services ISM also beat market forecast. So it wasn't all bad. You had a weaker manufacturing index, but with some softer inflation indicators. And then the services ISM was much more pleasing. It rose to a 21-month high of 53.8, which was well ahead of expectations and obviously easily above that break-even 50 level. So a mixed bag from the ISM indices. Also the jobs report, the May jobs report, which came out on Friday night. So we only got these figures on Saturday in New Zealand. That was stronger than expected in terms of the number of jobs that were created. We saw 272,000 new jobs created during the month. So markets were only expecting 175. And last month we saw 165, so 272. That's very good. That's healthy. However, the headline unemployment rate also increased, and that wasn't expected. Markets expected it to be steady at 3.9, pushed up a little bit, went to 4%. That's actually the highest we've seen since January 2022, so more than 2 years ago. And that was the last time we saw the unemployment rate in the US start with a 4. So unemployment is definitely pushing a little bit higher. Wage growth was also a little stronger than expected. Average hourly earnings increased 0.4% for the month. That was marginally higher than expected. And the annual rate of increase was 4% flat, which was also a little more than expected. So that does complicate things slightly for the Federal Reserve, which meets this week. And we'll talk about what that meeting, what we're expecting for that meeting shortly. The other big event last week was the European Central Bank meeting, the ECB meeting, and they did cut interest rates, which was expected, but it's still somewhat of a milestone. They're really the first major central bank to cut interest rates this cycle. They reduced their policy rate, OCR equivalent, from 4%, which is a record. That's the highest we've seen since the euro came into being back in the late 90s. So they cut it by 0.25%, so it went from 4% to 3.75. That's the first cut from the ECB since late 2019. And a day before that, we actually saw the Bank of Canada also cut interest rates. The Bank of Canada was the day before the ECB, and so that sees the Bank of Canada as the first G7 central bank to cut interest rates this cycle. We've already seen interest rate cuts in Sweden and in Switzerland this year, but those central banks are a lot smaller than the Bank of Canada, and the Bank of Canada is certainly a lot smaller than the ECB. So you can see the trend here, can't you? It's early days and everyone is moving at a different pace, but we're starting to see the first interest rate cuts after a long period of rising interest rates. So I think that does bode well for investors when you're thinking ahead 6 months, 12 months, because we're not quite there when it comes to New Zealand or the United States or certainly Australia, but those interest rate cuts are on the horizon in many of those places. But back to Europe, we have seen good progress on inflation in Europe, which is why the ECB has been able to move earlier than others. The pace of annual growth in the headline CPI came in at 2.6% in May. That was a little hotter than expected, but at 2.6, that is still well down from the peak, and it's lower than you're seeing in many other parts of the world. So, rate cut from the ECB, will there be more? Yeah, I think there will, but they might go a little bit more slowly than some have expected. Their next meeting is in July. I don't think they'll do anything then, so it won't be a string of cuts, meeting by meeting by meeting. I think in July they'll probably hold firm and then maybe think about another cut later in the year. Markets at the moment see 1 or 2 rate cuts more before the end of this year. So they might move again, but not necessarily at the next meeting. And when you look at their forecasts, because we've got a new set of forecasts at this meeting, they did actually increase their inflation forecasts for this year and for the next year slightly. So they're not completely out of the woods yet, and the easing that we do see could be a little bit more drawn out than you might otherwise see. But that's still somewhat of a milestone, the first rate cut from the ECB and obviously the Bank of Canada as well. That's interesting to watch. So, looking ahead, it will be a very busy week in the United States, and the highlight of the economic calendar in terms of releases will be the US Consumer Price Index for May, the CPI, inflation. Now, this is due on Wednesday in the US, so we'll get it on Thursday. And a month ago, markets were quite happy about the latest CPI report because that did come in a little softer than expected. That was for April. And that was pleasing because before that, we'd seen 3 consecutive months of higher than expected readings. And then last month, it was kind of as expected. So that's good. For May, markets are expecting the headline to increase 0.1%. That would be the lowest in 7 months. That's just the monthly change. And the core CPI is expected to rise 0.3%, which would be the same as we saw last month. And when you translate that to the annual increase, which is sort of what everyone follows more closely, the headline CPI would be steady, an increase of 3.4%. So that will be the annual inflation rate, 3.4% unchanged from April. The core CPI would come down to an annual rate of 3.5%. So that would be the lowest we've seen since April 2021. So going back more than 3 years, and it would be down slightly from 3.6% in April. So this is the key economic release of the week in the US and internationally, to be honest, and that'll be out on Wednesday. We'll get those figures on Thursday when we get out of bed. Right, the timing here is interesting because the Federal Reserve also meets this week. So their meeting will take place on Tuesday and Wednesday in the US. So while their meeting is going, they will get these new CPI figures. And we will hear from the Fed in terms of the release of their decision about what they do at 6 a.m. on Thursday morning in New Zealand time. So that will only be a matter of hours after that May CPI report. The Fed won't make any changes this week. You're not going to see any change to their Fed funds rate, which is sitting at 5.5%. So they'll still be on hold. But what we will get that will be really interesting, in addition to the press conference and the commentary and so forth, that is always interesting, is that we will get a new summary of economic projections, SEP, a forecast set from the Federal Reserve. So the last one of these we got came out in March, and that pointed to 3 rate cuts this calendar year, and then another 3 in 2025, and then another 2 beyond that, which saw their Fed funds rate ultimately settle at 2.6%, which I guess is what they see as sort of the steady state level. So since then, since March, inflation has been more persistent than hoped, and markets now just see the 1 or 2 rate cuts this year. So it'll be interesting to see if the Fed changes its forecasts and brings them more into line with what the market is thinking. And you would think they would, because they're actually running out of meetings to do the 3. So they're not going to do the 3. They will be doing less than that, if any. Markets think that we will still see cuts this year. Markets are 50-50 of a cut coming in September, but those odds rise to 80% by November. So maybe it'll be just the 1 cut from the Fed, maybe it'll be 2, who knows, but we'll be watching those forecasts, and then we'll be listening very closely to Fed Chair Jerome Powell at the press conference to see where his head is at, and what the Fed is thinking more specifically. So a big week in the US with that inflation reading out on Wednesday overnight. We'll get it on Thursday, and then 6 a.m. we'll get that Fed decision Thursday morning New Zealand time, and then at 6:30 tune in to listen to Powell speak in the press conference. Other major releases this week in the UK, we'll get monthly GDP figures, we'll get some fresh labour market indicators. Those will be interesting because we've got the Bank of England that meets next week, I think on the 20th of June, and also the Bank of Japan. It will release its latest monetary policy decision on Friday, and this one will be closely watched too. I'm not sure what time it'll come out. I don't think the BOJ announces a specific time. It'll just come out sometime in the afternoon. But in March, the BOJ made some quite historic changes to its monetary policy settings. They increased interest rates into positive territory. That ended 8 years of negative interest rates. So it was the first hike we'd seen since 2007. 17 years ago, and it ended that era of unorthodox monetary policy settings and marked a really important shift in focus. They've had decades of stimulus, really, that's been focused on reflating growth. They also abandoned their yield curve control regime, which they'd introduced in 2016. So that March meeting was a really important one. They've obviously had all those policies in place to keep interest rates very low, to encourage consumers to spend, to encourage businesses to invest. And they were trying to stave off those deflationary risks because inflation was well below where they wanted it to be. And the annual inflation rate is now sitting at 2.5%, and it's been above 2% now for 26 months. Before that, before it sort of pushed above 2% just over 2 years ago, it was tracking below 2% since 2015 or thereabouts. So they've been quite different to everyone else. They've had a long period of almost deflation, and they've been trying to get inflation higher. So they're meeting on Friday. You won't see any changes to their policy settings, but markets are picking another interest rate hike, another increase to come from the BOJ later in the year. So we'll be looking for any guidance on that and any change in thinking from the Bank of Japan. Across the Tasman, it will be a holiday shortened week. Obviously, we had our King's birthday holiday last week. The Aussies will get it this week on Monday, so it'll be a 4-day week, but still a bit going on. Highlights across the Tasman will be the NAB survey that's out on Tuesday, the business survey, then the latest labour force report, unemployment and so forth. That is out on Thursday afternoon. Both of those things will cover the month of May. The Queensland Budget also out, I think, on Tuesday, and that'll be interesting to financial markets because it will include a debt issuance update that will be interesting. Locally, lots of data releases. We've got the ANZ truckometer, we've got migration, we've got electronic card transactions, we've got the selected price indices for May, which is the report that comes out from Stats NZ every month now, and it gives you a bit of a feel for where some inflation measures are tracking. It's only selected parts of the baskets, but it is the best we've got in terms of a monthly indicator, so that will be interesting on Friday. We'll also get the latest housing market report from the Real Estate Institute. This will be out on Friday at 9 a.m. It'll cover the month of May. Last month, this was quite sluggish. It did reflect a market that had lost momentum since where it was at late last year. Nationwide sales volumes fell 17 odd percent in April. The days to sell was sitting at 44 in Auckland, 41 elsewhere. The house price index slipped 0.8% for the month. Auckland prices were down more significantly than that. So the housing market is very much a mixed bag across the country. There are some bright spots, but more often than not, you've got a situation where buyers are on strike a little bit, and you're not seeing that high demand, and people certainly don't want to pay the prices that many vendors are asking for. So it's a tough market out there when it comes to real estate. I know you've seen some policy changes from the government that are a bit friendlier to the housing market, and we are talking about potential OCR cuts on the horizon, November, in the eyes of financial markets, early next year in the eyes of the Reserve Bank and some of the trading banks. I probably think we'll get them this side of Christmas. So that's not too far away, but you've still got mortgage rates that are going to end up staying much higher than we've seen over the last several years, even if they do come down a bit. Plus, you've got rising unemployment. Plus, you've got an economy that is looking very, very challenged. So I can't see the housing market sort of running away on anyone. I think if you're a buyer, it's probably not a bad time to be looking, because it's very much more a buyer's market than a seller's market. If you're lucky enough to have the money to buy or the finance in place, you're probably in the minority, because a lot of people sort of don't. So you probably can pick and choose a little bit more than you've been able to in the past. But I wouldn't say there's any great rush. I just don't, I really struggle to see the housing market taking off again. I think there's just as many headwinds, if not more headwinds, than there are tailwinds. So probably not a bad time to be a buyer, and you can probably afford to be a little bit patient and a little bit fussy. But we will get some new figures out on Friday, so that will be interesting.
On the corporate front, it's a pretty quiet week. Not much here in New Zealand, not much across the Tasman. Internationally, there's a few results. Oracle on Monday and Adobe, the other interesting one that will be worth watching out of the US on Thursday. But other than that, that is probably all that there is of note. So thanks for listening, everybody. Enjoy your week, and we'll talk again soon.
For more insights, visit craigsip.com.